There's a story in the market this week that really caught my eye. Vanguard. Yes, that Vanguard. The name practically synonymous with indexing just made a big move into active management. Now, for decades, Vanguard has been the loudest voice in the room saying, you can't beat the market, just buy the index. Keep costs low and stay the course. And suddenly they're launching actively managed funds and filing for active ETFs. That's not just a product launch, that's a philosophical shift. When the high priest of indexing starts preaching active management, that's worth asking. What changed? Here's the truth. The market we're in today isn't the one John Bogle built the index model for. Back then, broad diversification actually meant diversification. Today, the S&P 500 is more concentrated than ever. A handful of mega-cap stocks drive the majority of returns, and investors are calling that diversified. That's not diversification, that's dependency. Indexing has a few fallacies that more people are starting to wake up to. The first thing is that market cap weighting doesn't equal smart weighting. The bigger a company gets, the more of your portfolio it controls, whether it's a good value or not. The second thing is cheap isn't always better. Fees matter, yes, but risk and positioning matter more. Being fully invested in weakening areas just because it's cheap isn't a strategy. Passive doesn't mean safe. When internal market health breaks down, when breadth weakens, momentum stalls, an index doesn't get defensive. It just rides the wave down. So when Vanguard starts stepping into active management, that's not them abandoning indexing, it's them acknowledging its limits. It's saying maybe the old playbook doesn't work quite the same way anymore. And honestly, I agree. That's why our philosophy has always been rules-based active management. Not gut feel trading, not predicting the next headline, but following disciplined signals, trend strength, breadth participation, momentum, and valuation context. It's like flying with an instrument instead of just vibes. You're trusting your dashboard, not your emotions. When signals strengthen, we play offense. When participation narrows and risk rise, we get defensive. Because investing isn't about outsmarting the market, it's about out-disciplining it. Look, indexing still has a place. It's a tool, not the strategy. But this latest move from Vanguard tells you something. Even the biggest believer in passive investing sees value in being active again. And for us, that just reaffirms everything we've been saying all along. In a market built on algorithms, crowd behavior, and concentration risk, the edge isn't being passive. It's about being purposeful. It's having a rules-based system that helps you adapt when the world around you changes. If you found this helpful, share it with someone who still thinks just buy the index is a full-time strategy. The game has evolved and the best investors evolve with it.